Good afternoon and welcome to the NC Realtors Opportunity Zone webinar. This is the first in our series examining this new economic development tool. These webinars are being sponsored by the NC Realtors Economic Development Committee and the Realtors Commercial Alliance. My name is Seth Palmer, and I'm the Political Communications and Regulatory Affairs Director here at NC Realtors, and I will serve as your moderator for today's webinar. Before we get started, I have a couple of housekeeping items. Today's webinar is being recorded, and the recording will be distributed along with the slides from our presenter in the days following. Everyone's audio has been muted and your video feeds are turned off. You're encouraged to ask questions throughout today's presentation. In order to ensure that we capture all of them, please submit them through the Messenger platform within the Zoom webinar slide deck. We will get to as many of them as we have time, and we'll work to get any additional ones answered following the webinar. If you will allow me a few additional minutes here, I'm going to add in some additional folks who are in the waiting room, and then I will be turning the discussion over to Tony Harrington, Chair of the NC Realtors Economic Development Committee, for a welcome and introduction of today's speaker. Tony, are you there?
A fantastic Thank you, Seth, and welcome everybody to today's webinar on this important topic. This was a great response that we had for our first webinar in 2019. And on behalf of the NC Realtors Economic Development Committee and the Realtors Commercial Alliance, we're happy to kick off the first in our series of discussions on opportunity zones. And to give you a little bit of background, in 2018, Congress did pass the Tax Cuts and Jobs Act, creating the Opportunity Zones program. And this was to increase investment in economically distressed communities. The program provides preferential capital gains treatment for investments within designated low-income census tracts. And our policymakers hope that opportunity zones would unleash investment in low-income communities throughout the country. Now, our state governors were directed to identify sites in their respective states, and through that, thousands of sites were approved for inclusion within the program. And in fact, North Carolina currently has 252 sites that were approved. Now, as our program has gotten off the ground, one of the biggest questions that we were asked by realtors and economic developers is, how are these sites to be a benefit to clients and future business opportunities? And through this two-part series, we will present important information about the Opportunity Zone program, where the sites are in North Carolina, and what type of benefit they'll have for future development. And we're excited to kick off the first of this two-part discussion, and we thought it would be helpful to have a global perspective on the issue, and that we're happy to have Jessica Clancy from PricewaterhouseCoopers with us. Jessica Clancy is a tax director in the Boston office and has been with PricewaterhouseCoopers for 16 years. She specializes in the asset management practice, working on both the real estate and private equity funds. And Jessica has focused on the Opportunity Zone program for the last year and is instructed on the topic in a training capacity within her firm as well as members of the real estate community. She has helped clients structure investments to maximize the incentives of the Opportunity Zone program. Jessica has earned her BA in accounting from Bryant College, is a C.P.A, and is a member of the American Institute of Certified Public Accountants. And with that, Jessica, we welcome you to the program, and we look forward to hearing from you.
Great, thank you. Let me pull up this slide. Thank you for having me today. Like Tony said, my name is Jessica Clancy, and I'm a tax director with PwC, and I'm here to talk about the Opportunity Zone program. Like you said, this program was passed as part of tax reform at the end of 2017, and today we're going to walk through what this program is, why someone would want to take advantage of it, and some of the considerations that go along with it. So we will start with why opportunity zones. This is actually one of the few pieces of tax reform that actually has bipartisan support. There have been a lot of questions of what happens to tax reform if President Trump doesn't get reelected, and I am fairly confident that the Opportunity Zone program isn't going anywhere. This is the first national community investment program in over 15 years, and it really does have the potential to be the largest economic development program in the U.S. The program really is market-based, and the success of the program will be determined by the investors and and all the taxpayers. And I can tell you, I was on a call with the White House last month where the president signed an executive order announcing the creation of the White House Opportunity Revitalization Council. The primary goal of the council is to work with all levels of government to help streamline the program and make the program a success. They're going to collect data that will help them determine if the program is working. And I think this shows that the White House is really committed to making sure this program is a success. So what is the Opportunity Zone program? At a high level, this program allows any taxpayer who has eligible capital gains to be able to defer paying tax on those gains if within 180 days of the gain, they invest the gain into a qualified opportunity fund that holds qualified opportunity property. Like anything, there are certain requirements that need to be met and testing that needs to be done on a biannual basis to qualify. And I'll walk through all of these requirements as we move along. This truly is an investor incentive program that is aiming to promote certain investments in certain economically distressed areas. So what does the program offer? The program offers taxpayers 3 incentives. First, it allows a taxpayer to defer paying tax on a current capital gain until 2026. This is important. In order to take advantage of this program, the first step is identifying a capital gain that can be invested in an Opportunity Zone fund. We will get into what a fund is. Second, if the original amount of capital gain the taxpayer has elected to defer has been held in the fund for 5 years, then the taxpayer gets a 10% reduction in tax. And if the taxpayer holds it for a total of 7 years, they get an additional 5% reduction. The third incentive is if the investment is held for 10 years, any appreciation on that investment is tax-free. Now, this is a huge incentive. The program ends in 2047, so a taxpayer has the possibility to let an investment grow tax-free for 30 years. So if someone were to buy property in a zone with intentions to hold it for at least 10 years, they are really getting great tax incentives to do this. In this next slide, we can walk through an example. So if I own stock in a public company and I sell that stock, resulting in proceeds of $150 with a capital gain of $100. If I take that $100 capital gain and invest it in a qualified opportunity fund within 180 days of the sale, and I hold that investment for 5 years, after the 5th year, instead of paying tax on the $100 gain, I now only have to pay tax on $90. If I hold it for an additional 2 years, or a total of 7 years, instead of paying tax on the original 100, I now only need to pay tax on $85. Fast forward to 12/31/2026. This is when the tax on that original deferred gain is going to be due. So whether you invest in year 1 or year 5 or year 7, the tax on the deferred amount is due 12/31/2026. So in this example, I held that investment for 7 years, so I get the full 15% reduction in tax, and now I'm only paying tax on $85. And this is assuming that the fair market value of the interest is higher than the original deferred gain. If I hold it an additional 2 years for the total of 10 years, then any appreciation on this interest is tax-free forever, not deferred, completely tax-free. One thing I will point out, so in order for a taxpayer to take full advantage of these incentives, you know, the deferral, the reduction in tax, and the tax-free appreciation, the taxpayer would need to invest by 12/31/2019 and hold the investment for 10 years. So remember, you're paying tax on the original deferral on 12/31/2026. In order to get the full 15% reduction in tax, you have to hold the investment for 7 years. So counting backwards, that just means you have to have your investment in place by 12/31/19. Now, like I said, that's to get the full advantage of the program and all three incentives. You certainly can invest in a qualified opportunity zone in year 5 and hold it for 2 years and get a 10% reduction, and then, you know, it's 2026 and pay your tax then. But you would just miss out on that additional 5%. So qualified opportunity zones are low-income census tracts nominated by governors and designated by Treasury. Treasury allowed governors of every U.S. state to designate certain census tracts as opportunity zones. Tracts were generally low-income and high-poverty areas, although they also strategically nominated higher-end neighborhoods as well. Governors submitted their nominations to Treasury last March, and by last summer, all nearly 9,000 tracts had been approved by Treasury. At this point, we agree that it's highly unlikely that any additional tracts will be selected. So as we go through this, I have certain sort of unanswered questions here. Because this is such a new program and there are still a lot of unanswered questions, you know, Treasury did release the first set of proposed regulations in October, but there are still outstanding questions. The second set of proposed regulations were supposed to be issued in December, but with the government shutdown, those have been delayed. So a question like, what happens if I own a building that is partially in a zone and partially outside of a zone, is still unknown at this point. So this map shows a picture, you know, at a really high level of the 252 zones that North Carolina has. You can see they're generally spread out throughout the state. And if you have questions about a specific area, you can reach out to me and I can help you determine if that area is actually in an opportunity zone. There are some great, you know, tools online where you can enter in an address and it will tell you if it's an opportunity zone or not. So who can invest in the program? Basically, any taxpayer that is an eligible taxpayer can elect to defer gains under the program. And we are seeing all types of taxpayers taking advantage of this program, including individuals, C Corps, trusts, and businesses from all different industries. Treasury has tried to make this fairly simple. You can elect to defer gain by simply filing tax form 8949 with your tax return. So as I mentioned, in October, we got our first set of guidance of the proposed regs from Treasury. And in general, this guidance was very taxpayer friendly, which is encouraging. There have been other programs similar to the Opportunity Zone program in the past, such as the GO Zone and the DC Enterprise Zone, which you may be familiar with. And the rules there were very narrow in those programs, and the programs were not widely taken advantage of. So it seems this time around, the rules are much more broad and friendly in the hopes that this program does take off. One of the favorable rulings in the proposed regs relates to partnerships. So a partnership can elect to defer the gain themselves, or they can pass the gain through to the partners, and the partners would make an election on whether or not they wanted to defer. So there is some flexibility here. So let's get into what gains can be deferred. As I mentioned earlier, the first step in the program is identifying an eligible gain. Taxpayers need to invest capital gains in opportunity funds. They can't just take cash they have and contribute it and get the benefit. The taxpayer has to have a capital gain. The reason for this is there are approximately $6.1 trillion in unrealized gains sitting out there. And this is Congress's way of turning unrealized gains into realized and hopefully stimulate the economy and pump money into some of these distressed areas at the same time. So like I said, the gain has to be capital, not ordinary. And the gain must come from a sale or exchange with an unrelated person. Some questions we did get answered in the proposed regs. A taxpayer can invest cash into an opportunity fund in addition to gain, and this is what we would call a mixed fund, but any cash invested will not get any of the incentives. Allocations of debt from a fund does not result in an investment being treated as a mixed fund, so the fund can have debt. The capital gains must be invested in the form of equity. And lastly, if you invest short-term capital gain into the fund, then it remains short-term until the time the deferred gain is recognized in 2026. So in other words, the character is preserved. Even though you've now held it, you deferred it for however many years, it would still stay short-term. So let's talk about the 180-day rule. The investment into a qualified opportunity fund must be made within 180 days of the sale or exchange. When the gain comes from the sale of stock, for instance, then the 180-day clock simply begins the date you sold your stock. If the gain is coming through a partnership, then again, the rules are very taxpayer friendly. The taxpayer can either use the date the partnership had the sale itself, or the partnership or the taxpayer can elect to use the end of the partnership's taxable year as the date of sale. So if I am a partner in a partnership and an opportunity comes my way to invest in a qualified opportunity fund in, say, July, I may want to contact the partnership and ask them if they have had any realization events in the prior 180 days and use my share of that gain to invest. Or if my partnership has a December 31 year end, then I can have my 180 days begin after year end. We at PwC have been working with the Real Estate Roundtable to provide comments on the proposed regs, and one area we are hoping Treasury to clarify is what happens if I'm a minority partner that doesn't get a K-1 until after, June 30th. Then I'll have missed, the opportunity to invest any capital gains into a fund as the 180 days will have passed. So we are hoping that Treasury will allow for minority, partners to have 180 days from the receipt of their K-1. We're not sure if this will happen, but it's something that we've brought to Treasury's attention. If a taxpayer has a capital gain from a RIC or a REIT, then the 180 days begins the date the dividend is paid. Also, if the taxpayer is invested in a qualified opportunity fund and decides to sell their interest in the qualified opportunity fund for a capital gain, they can recontribute that gain into a new qualified opportunity fund, and the 180 days begins on the date the taxpayer disposes of the original investment. So they can keep deferring the gain if they continue to reinvest the gain into new qualified opportunity funds. Let's talk about what exactly a qualified opportunity fund is. I mentioned the first step is identifying a capital gain, and we know that we have 180 days to invest our gain into a qualified opportunity fund. But what is a fund? A qualified opportunity fund is the investment vehicle that one must set up to utilize the benefits of the program. The fund must be organized as a regarded entity, either a corporation or a partnership, for the purpose of holding at least 90% of its assets in qualified opportunity zone property. The entity must be organized in one of the 50 US states or DC. And although pre-existing entities are eligible if they meet the OZ program requirements, we are seeing, though, that most taxpayers are setting up new legal entities for the purpose of this program. And it's important to note that a taxpayer must own its investment through a qualified opportunity fund and not own the property directly. As I mentioned earlier, there's a 90% test, and this is done biannual. And another piece of favorable legislation is that Treasury is allowing taxpayers the ability to self-certify that they are a qualified opportunity fund and pass the test simply by filing tax form 8996 and attaching it to the fund's tax return annually. So a qualified opportunity fund must hold at least 90% of its assets in opportunity zone property. So this can be stock in a corporation, an interest in a partnership, or qualified opportunity zone business property. If it is stock, then it must be stock in a domestic corporation that was obtained by the fund after 12/31/2017. And the corporation must be a qualified opportunity zone business at the time of purchase. Similar thing with the partnership interest. It can be a capital or profits interest in a domestic partner, but must be obtained by the fund after 12/31/2017. And again, the partnership must be a qualified opportunity zone business at the time the interest was acquired. Business property is defined as tangible property used in a trade or business. And when looking at the 90% test, we do know that the assets are valued as reported on the financial statements. It really is Treasury's goal for businesses to move into these areas. That is why the rules state that the stock or partnership interest and tangible property must be obtained after 12/31/17. They didn't want people to take advantage of the program with successful businesses that are already in the zones. So there is still a lot of uncertainty surrounding the qualified opportunity zone business piece of the program. And as I mentioned, we're expecting guidance out in the next month or so. So that should address a lot of the uncertainties on this topic. What we do know is that to be a qualified opportunity zone business, 70% of the tangible property owned or leased by the business has to be qualified opportunity zone business property and is used within the zone. Also, at least 50% of total gross income of the opportunity zone business is from the active conduct of the business. Again, this is something that has not been defined yet, but we are hoping for clarification on what is an active conduct of the business. For a business to qualify as an opportunity zone business, the non-qualified financial property must be less than 5% of the OZ business assets. Non-qualified financial property generally means stock, partnership interest, debt, options, forward, futures, etc. And while, like I said, there's a lot of uncertainty around which businesses will qualify, we do know that certain sin businesses do not qualify. So those are your country clubs, massage parlors, liquor stores, etc. So getting back to the non-qualified financial property, in addition to this list, we do know that working capital held in the form of cash, cash equivalent, or debt instruments with a term of 18 months or less are excluded from NQFP. I also want to mention that there is an exception for cash that qualifies for the working capital safe harbor. And we'll get into that. So what this means is there is a safe harbor for what constitutes a reasonable amount of working capital for an OZ business. Amounts are considered reasonable if 3 requirements are met. First, the amounts must be designated in writing for the acquisition, construction, or substantial improvement of tangible property in a zone. Second, there must be a written schedule consistent with the startup of a trade or business for the expenditure of the working capital, and the schedule must show the assets being used within 31 months. And third, the working capital assets must actually be used in a manner consistent with the first 2 requirements. So this is great news for someone who is, developing property in the zone. As long as they have a plan in place, they can hold on to a bunch of cash for up to 31 months. In order to qualify as tangible property used in a trade or business, like I said, the property must be purchased after 12/31/17. The property's original use either commences with the Qualified Opportunity Fund, or the Qualified Opportunity Fund substantially improves the property within a 30-month window. So this means if you buy an existing structure for $100, within 30 months, you need to put an additional $101 into that structure. That's their definition of substantially improved. And lastly, during substantially all of the Qualified Opportunity Fund's holding period, substantially all of the property's use must be in a qualified opportunity zone. It is important to note that Treasury has not yet defined substantially all in that aspect. Again, Treasury's intent here is for developers to buy rundown buildings that may even be vacant and then substantially improve them and get them back up and running and filled with tenants. The IRS did release Revenue Ruling 2018-29, which basically states if you buy land and building for, say, $150 and you allocate $50 of the purchase price to land and $100 to building, again, you would only need to substantially improve the building. So you would have to put $101 into the building. One thing that isn't on the slide, but I want to point out, is that it is also important to note that OZ business property cannot be purchased from a related party. So Treasury didn't want people essentially selling property to themselves and use the program that way. And I will say one more thing before we leave the topic of OZ businesses. We know that Congress's intent was for new startups to open up in the zones, for businesses to move into the zones, and for cash to be flushed into existing businesses that are already in the zones. So we do anticipate a lot of the uncertainty to be addressed in the next set of guidance, and for it to be taxpayer friendly. If a Qualified Opportunity Fund fails the 90% test, the fund will not be terminated. They will likely have to pay a penalty for each month they fail to meet the requirement and then move on. Some practical considerations. First, let's talk about liquidity of investments in a Qualified Opportunity Fund. The way the rules are written right now, in order to capitalize on the appreciation exclusion, so remember, if the taxpayer holds the investment for 10 years and then decides that they want to get out of this investment after 10 years, all the appreciation is excluded. What happens is the taxpayers need to sell their interest in the fund itself. The fund can't sell the underlying property. Second, we've had a lot of taxpayers that are either looking for other investors to join forces with, or some taxpayers may already own property in a zone and are looking for developers to help develop the property. So just, you know, things that investors are thinking of. And there are definitely state tax considerations to contemplate. Not all states, including North Carolina, have conformed with the new federal rules. So, you know, definitely an analysis will need to be done. What this means is that for North Carolina state tax purposes, you will likely have to include the gain into income when recognized. There is no deferral piece here. And then lastly, you know, things to think about is the compliance and reporting we talked about. So, you know, remember, in addition to filling out the form to defer the capital gain, you know, in the form to self-certify the qualified opportunity fund status, most taxpayers, like I said, have formed new entities, whether it's a partnership or a corporation, to become opportunity zone funds. And these funds are still going to have an annual tax obligation, and they're still going to pay tax on any positive earnings received throughout the year. It's important to remember that the only tax that is deferred is on the original capital gain. But, you know, likely the fund is still a business earning money, and you're still going to pay tax on that year after year after year. And then it's the appreciation that we talked about that's excluded. So that is all I have for slides for today. We just spent the last half an hour going through a lot of information. I'm not sure if anyone has any questions. I've included my contact information in the slides, as well as that of two of my colleagues who are also working on this program with me. So certainly, you know, if something doesn't get answered today, please feel free to reach out to one of us, and we'd be, you know, happy to look into any questions that anybody has.
Thank you, Jessica. I'm going to rejoin the conversation here and ask a couple of the questions which have been provided.
Sure.
Also, just to let everybody know, if you do have questions, feel free to submit them through the chat platform on Zoom. I'll actually ask and answer one of the first questions that would ask is there a map available of the approved census tracts? Yes, and we will be talking about a resource that NC Realtors has launched already that will show that link. Jessica, one of the questions that has come in is, does the taxpayer pay the gain after 10 years of initial investment if no capital gain is being reinvested, excuse me? If the example that's provided is, I build for $1 million and 10 years later sell for $2 million, is there tax paid on the $1 million gain?
No. So as long as you hold the investment for 10 years, any appreciation that happened during those 10 years is tax-free. So the only tax you're paying is on the original gain that you deferred. You pay that in 2026, but then any appreciation from year 1 to year 10 is tax-free.
Okay. The next question we've received is, can an IRA invest in a qualified opportunity fund?
If the IRA has eligible capital gains that it would have to pay tax on, then yes, it can defer paying tax on those capital gains and invest in an opportunity zone fund.
Okay. Can you transfer with a 1031 into a qualified opportunity fund?
So there has been talk about like-kind exchanges and how that works with opportunity funds. Let me get back to that let me get back to you on that one. I want to see where we stand on our latest thoughts on that.
Okay. I'm going to ask the question that was provided, but I'm not sure I fully understand it. But I'll ask it as was presented. Are cemeteries allowed or excluded? Does that make any?
I'm assuming if the cemetery is within the opportunity zone, and you invested in a fund that owned the cemetery, and there was appreciation on the land, I would have to think that it would allow as a good asset. I haven't been asked about cemeteries before.
I did just get a clarification from the person who asked the question. She said that it was in the list of allowable businesses where you excluded things like massage parlors and country clubs. So it would have been back on that slide, I believe.
Let me go back. So I don't have cemeteries listed there.
Okay.
I think cemeteries would be okay.
All right. Next question that we've received would a 5-bedroom, 5-bath house turned into a bed and breakfast qualify as an opportunity zone business, assuming the home was in an opportunity zone before the conversion to a bed and breakfast?
Yeah, so yes, if you would either have to substantially improve, but it sounds like it wouldn't be necessary in that case if I'm assuming it's, you know, a house that's fine. But yes, because the original use, it would be a new business, it would be original use, would commence with the startup of an OZ fund that would allow it to qualify.
Okay. Next question is, what is the projected date to have all of the details, and by that I would assume the guidance from the IRS finalized?
So that's a tricky question because of the government shutdown. Originally, they were pretty adamant that it was going to be by 12/31/2018, and then with the shutdown, that delayed it. I think we are hoping within the next 30 days, but you know, right? So I think what the shutdown is the government's back on for 3 weeks, I think it was. So I think it sort of depends on what happens after that. Yeah, it's sort of an unknown at this point.
Sure. Returning to the question about IRA, would a Roth IRA be treated any different from a traditional IRA as far as participating in a qualified opportunity fund?
A Roth IRA, I would think, you know, again, if they were to have a capital gain that they typically would have to pay a tax on, then they would be an eligible investor that could defer paying tax on that capital gain and invest in a qualified opportunity fund.
Okay. A couple more. If selling an existing property for 200 with a taxable gain of 100, would the 200 need to be invested in the qualified opportunity fund, or only the 100?
Only the 100. So okay. It's only gains. It's not proceeds.
Okay. is the deferred capital gains due if any money is still invested in the the qualified opportunity fund for over 10 years?
So the deferred gain, the tax is due on that on 12/31/2026, which is less than 10 years from now. So no matter what, that tax is due on the original gain on 12/31/2026. And then, like I said, any appreciation, there would be no tax on that.
Okay.
Does that answer the question? I think that answered the.
I believe so, yes. The next question is, can you please review the role of cash in a qualified opportunity fund?
So here's my slide on cash. So there's a couple of parts, right? So if you have a lot of cash, right? So a lot of investors are contributing all of this cash into a fund. You have this working capital exception where, you know, amounts that are for the acquisition, construction, or improvement, you can hold that cash for up to 31 months, you know, as long as you have this schedule in place and you've got this and you spend it within 31 months based on the schedule and what it was intended for. Then it's not part of your non-qualified financial property. So the Treasury doesn't want, you know, these funds set up sitting on a bunch of cash for, you know, 8 to 10 years. They're trying to get this cash like put into the economy and put into, you know, businesses and revitalization and not just, you know, sitting in a bank account.
Let me ask a follow-up question there based on an example that the question asked. If gains of $100 are used to purchase land, then cash of $200 is used to build a structure. Would the appreciation of the $300 asset be capital gains free if held for 10 years, or are only the fund that let's say, hold on, sorry, or
yeah,
are the only funds that can be used must be gains taken from prior investments?
Right. So you would only get the benefits on, what was that? What would you say, 100 and 200? So 300 total. So you would get like a third of the benefits because a third of the amount contributed came from gains. So you would want to contribute all $300 in terms of gains in order to get the full exclusion of paying tax on the appreciation.
Okay.
You certainly can put cash in. You just won't get you won't get the benefit for it.
Sure. I'm gonna provide just a little bit of information to everybody who has asked this question. We will be providing access to these slides and Jessica's contact information following this presentation. Last couple questions, and then we will wrap this up today. How and who will be reviewing the investments to ensure that there are improvements made within the 31-month period?
So this is a good question. Right now, the only guidance that we have out there is for that form 8996 that will be filled out, and I think that will. I don't have it up in front of me, but I think that has, you know, information on it, and you would attach that to the fund's tax return. But right now, there isn't, you know, other than filling out that form and mailing it in, there isn't really any other guidance on sort of, you know, who's going to be checking up on all of this is, I think, what they're asking.
The final question that we've received is, are there return on investment targets of qualified opportunity funds compared to other investment options, if applicable? Management fees associated with a qualified opportunity fund, and are they deductible for the investor?
Yeah, I'm certainly seeing partnerships get set up that, have a that are paying management fees, and that's fine, or have a preferred rate of return, have a preferred rate of return to partners before, it all depends how it's structured and set up, I think. If there's a developer involved, but the economics we've generally seen very similar to a typical real estate fund or a private equity fund in terms of, making sure they get their return and stuff like that. It may not be as high because of the benefits of the program that the investors are getting, but there's certainly, economics in place to make sure they're getting some sort of return.
And I do have one more that just came in. This will be the last one. Any additional questions that we receive via the group chat portal, or you're welcome to email me and I'll be glad to forward those on to Jessica and provide answers to the group. Would a refinance cash out on the property bust the capital gain benefit and deferral?
Say that again. With the what?
Would a refinance and cash out on the property bust the capital gain benefit and deferral? Is the question that was asked. We might take that one offline and ask the individual to provide some more information.
Yeah, yeah.
If whoever asked that question would email me at spalmer, Palmer, at ncrealtors.org, I will forward that on to Jessica. But I would like to take this time at this time to thank Jessica for her presentation and for the great information. This has definitely been very helpful as we continue to understand the Opportunity Zone program. One of the things I wanted to call everyone's attention to, in addition to the slides and the recording of this webinar, NC Realtors has created a new page on our website that looks at opportunity zones and provides as much information as we have available at this time. So you should be seeing a shared screen of ncrealtors.org/opportunity-zone, which is our new portal, which lists a lot of this information. As you scroll down, you will see the page for the Opportunity Zone program here in North Carolina. And if you click on that link, it will take you to an interactive map that the North Carolina Department of Commerce has put together that shows you where these zones are located and can help you drill down to census tracts. So thank you again for taking the time to participate in this webinar. Please watch your email for the slides of this presentation and the recording, as well as information about part 2 of this webinar series focusing specifically on the zones here in North Carolina. Thank you again and have a nice day.